The Fed hiked another quarter point, taking its key rate to a 22-year high. Joining me now to discuss is Andrew Foran, economist with TD. Andrew, did anything surprise you today?
Broadly speaking, the decision came in along with expectations. Market pricing was for roughly 100% probability that this would be the outcome of today's decision. And looking at the statement, it is consistent with what the Federal Reserve has been saying in the communications to the state. And then in addition to that, we also, of course, had the June summary of economic projections, which showed that committee members anticipated the need to raise rates by another 50 basis points this year. And then also on top of all that, we had the economic data come in, and it was broadly supportive of the decision by the Fed today. We saw that there was some downward movement in headline inflation in recent months, but with that broadly due to energy prices, core has remained fairly elevated. And then also in terms of the labor market, we have seen some continued strength on that front. We've seen in the most recent job data that we have, roughly 500,000 jobs added in May and June. The unemployment rate has remained steady and low at 3.6%. And then, of course, we have the most recent data for job openings showing just under 10 million job openings in the economy, equating to about 1.7 for every unemployed individual in the economy. And this just provided the foundation that the Federal Reserve needed to go ahead with the additional 25 basis point hike today.
Okay, so now coming into this meeting, there are some investors who are hoping that the Fed might halt their interest rate hiking campaign. How much further do you think the Fed will go before it pauses on further rate hikes?
So our baseline expectation is that the Federal Reserve will hold rates at the current level after today's decision in order to give themselves more time to fully assess the cumulative and lagged effects of past rate hikes on the economy. We've had a fairly large 525 basis points worth of rate hikes since March of 2022. And the Federal Reserve just wants to give itself more time to fully evaluate how that is affecting the economy. So we have seen some preliminary indications that inflation is beginning to come down, but not enough to fully justify a pause up until today's decision. So the Federal Reserve will be continuing to monitor this moving forward.
Okay, so as they continue to monitor, what other potential risks do you see to the Fed's outlook?
Sure. So likely the primary risk at this point in time is that the resilience that we saw during the first half of this year could hand off into the second half of this year as well, which would then put a floor under demand in the economy with the inflationary pressures and then resulting in the Federal Reserve having to push rates higher and keep them there for longer. And then also there's other risks on the horizon as well with the end of the student debt moratorium, which is expected to come at the end of the summer. We anticipate that that is going to shave about 0.3 percentage points off of consumption by the middle of next year. However, it's possible that could have a bigger impact given the elevated pricing environment that many consumers find themselves in. And then on top of that, there's always the fact that we're still in a dynamic economy, and the downward trend in inflation is not going to be happening in a bubble. There's still the possibility that there could be external shocks, which might derail the progress on getting inflation back to the Fed's 2% target.
Okay, so we know the next Fed meeting is not until September. What are some of the indicators that you'll be watching closely as the Fed considers its next move?
Sure, so we get a host of economic indicators in the next week or so. Importantly, tomorrow we'll get the advanced estimate for second quarter GDP. We'll get to see whether or not that resilience that's showing up in the higher frequency indicators is translating to the aggregate level as well. In addition to that, on Friday, we get the personal income and spending data, which will show PCE inflation for June. We saw core CPI trend down in June. It'll be interesting to see whether or not that translates into core PCE as well. It's been notably stubborn since the start of the year, hanging around that 4.6 year-over-year growth rate. So seeing downward progress on that front would be a positive development. And then in addition to that, the employment data that comes out next Friday. Consensus expectations right now are that it's going to be the first sub 200,000 monthly job gain in 2.5 years. So that would be another positive development if we do see some moderate cooling, continued cooling in the labor market.
Okay, and finally, I want to talk a little bit about the US dollar. Where do you see it going in the next little while?
Sure. So moving forward from where we are right now, we are looking at a slowdown in global economic growth. And historically, that has been consistent with relative strength in the US dollar. And our baseline expectation is that the Canadian US dollar exchange rate will be in the range of 0.75 to 0.73 over the course of the next year. However, it's important to note that the relative position of the US dollar will be dependent on the success of central banks, their relative success in getting inflation back to target, and also their success at minimizing potential adverse economic outcomes, which might manifest from the aggressive monetary hiking that we have had.
Andrew, thank you very much for joining us.
Thank you for having me.